Okay, so today we are going to be talking about fair value gaps. Fair value gaps are possibly one of the most important technical concept, at least, because the fair value gaps, they serve a very, very big purpose when it comes for us as traders. They are going to help us form direction. They're going to help us give us entries. They're going to show us in terms of direction. They're going to show us the market shifts, the continuations. And that is why fair value gaps are so powerful, because they're very versatile in what you can do with them. And that's why I want to talk about fair value gaps. This is going to be a two-part where I'm going to be talking about fair value gaps at first, and then we are going to apply fair value gaps a lot on the charts. I will show you charts right now, but know that a lot of what we are going to talk about is what fair value gaps are, how do they look like, what the different type of fair value gaps are, and also what they do to us. And the levels that are important, so on and so forth. So in terms of fair value gaps, you need to understand that, as I said, they are used for multiple things, and that's why it's such a versatile piece of information for you to understand. So they're used both for direction and for entries. And in terms of direction, they're going to be able to show you the market shift. I will show you that fair value gaps, they are the first signs that the market is shifting. And then for continuations, fair value gaps are supposed to be respected. And so fair value gaps hold a very strong place in the market that allows us to then analyze the market very nicely and have good reaction points. And this also keeping in mind that fair value gaps are one of the most important concepts for you to understand the daily bias, for you to understand where the market is heading. So once again, direction. Now let's talk about, what do fair value gaps look like? Well, fair value gaps are 3-bar patterns, right? That's what they are. They're basically the gap between the high of the first candle and the low of the third candle, this on a bullish fair value gap. Obviously, if this wick would have been all the way down here, then there would have been no gap, therefore no fair value gap. Same thing on the bearish, where if this would have been all the way up here, then there would be no gap. Now, there's one thing that is important. I don't want you to overthink fair value gaps. I think that one of the problems of a lot of traders is that they start adding so many different things, like this word and this word and this word, and all of a sudden they're like, wait, but is this a fair value gap? Is this the BPR? Is it breakaway gap? Inverted? What is this? And you get analysis paralysis. I don't want you to have that. So I'm going to tell you different types of fair value gaps that we have, but I don't want you to overcomplicate it. We have, because most of them, they're just fair value gaps. That's the thing. Most of them, they're just fair value gaps with a added thing on top of it. It's not too important, right? But I want to tell you the most important ones. So first of all, it's the balanced price range, or what people call the BPR. So the BPR is, for example, by the way, sorry, I'm going off on a tangent here, but have you ever heard the word SIBI and BISI? That's the same fucking thing as fair value gap, as bullish fair value gap and bearish fair value gap. That's what pisses me off with people that are teaching. It's like, oh, no, this is not the fair value gap. This is the SIBI. Same fucking thing. It's the same fucking thing, right? So don't overthink fair value gaps or SIBIs, or don't fucking overthink it. It's a fair value gap, okay? My God, people piss me off. That's why I'm doing this bootcamp, because people fucking piss me off with this unnecessary jargon. It's unnecessary. Now, let's go on extra jargon. So what is a balanced price range, or BPR? It's just a fair value gap and another fair value gap overlapped. And that's a BPR. It's a fucking fair value gap. It's two fair value gaps that overlap each other. That's what a BPR is. And you know what? I was going to talk seriously about the fair value gap and the BPR, and the breakaway gap is actually quite important. But the BPR. But it's just a fucking fair value gap that is overlapping with another. I'm sorry, I'm going to stop cursing, but it's the thing. It's just a fair value gap that is overlapping with an inverted fair value gap, which we will talk about below. Right? So a BPR is simply two fair value gaps that overlap. If you extend the fair value gap that was inverted, which we will talk about right here, if you extend the fair value gap that is inverted and it overlaps with the fair value gap that we are currently looking at, the most recent fair value gap, that is a high probability fair value gap, a BPR, especially if in line with a higher time frame PDRA, like a higher time frame fair value gap, like a daily, like a weekly, like even a 4-hour fair value gap, and or even a high and a low, the liquidity sweep. These can be extremely, extremely powerful. And then this is the bullish BPR, which is again, so when we have bearish fair value gap and bullish fair value gap. So that is the BPR for you. Now, breakaway gap. The breakaway gap is actually quite important. That's why I actually stopped talking that much, that loud. So the breakaway gap is a gap that should not be traded into. What that means, or at least it shouldn't be closed, but it shouldn't even be traded into. The breakaway gap, it gets marked by the third candle, because as you can see, we have normal candle, and the third candle is actually very, very impulsive. The same thing on the bearish one, where the third candle is very, very impulsive. And what that means in terms of a fair value gap is that there's so much momentum behind the market that the market doesn't even have to fill the gap in fair value, which is what a fair value gap is. But what you expect from a breakaway gap is that it should not be traded into. So if we quickly add right here a rectangle, just saying fair value gap that should not be traded into, right? This is all we need. And I know this is looking crazy. So we just do this, right? So this is a fair value gap that should not be traded into, and that is marked by the third candle. How many times have you probably trying to use the fair value gap, you would set your limit orders at the fair value gap and the market would never go into your fair value gap? The reason why is because there's so much momentum behind the market that a breakaway gap is very, very likely to include a fair value gap on a lower time frame, or at least this is going to be the order block that the market is going to come, tap into, and then move to the upside, right? So the breakaway gap is not expected to be traded into due to the momentum on the third candle. And we'll see those in action once we go into the charts. And last but not least, it's the inverted fair value gap. We've already seen the inverted fair value gap. By the way, like if you really want to go a little bit deeper, notice how this inverted fair value gap has a fair value gap here. Therefore, this is, if you go down just towards this is the BPR, right? So those are two overlapping fair value gaps. But the inverted fair value gap is basically a bullish fair value gap that it gets completely disrespected. How does it get disrespected? When the candle closes below or above on a bullish fair value gap and on a bearish fair value gap respectively, when they close below or above, because that means that this fair value gap did not hold. It did not. The fair value gap, what is its purpose? A bullish fair value gap, the purpose is for it to be support for the market to move to the upside. Now, if the market closes below it, that means that that fair value gap failed to do its job. Therefore, now it's a bearish inverted fair value gap because it's a bullish fair value gap that was completely disrespected. Now, we've already talked about what they are used for. So they're used for direction, they're used for market shifts and continuations, and they're used for entries. We'll talk about all these still in this video. So next one, what levels do we look out for in fair value gaps? Well, there are three: open, consequent encroachment, or 50%. Again, I don't even know how to write consequent encroachment. That's why I wrote CE. That's how much it doesn't matter. I call it the 50%. I don't even know what consequent encroachment means, and I don't really care. I'm still profitable, right? And then the close. Now, on a bullish fair value gap, these are the three levels: the open, the 50%, and the close. And then we have the close, the 50%, and the open. Now, you might say, but Kemal, this is actually the other way around. And no, because this is the thing. If we go all the way down, this is a gap. If price goes all the way down here, it has now closed the gap. That's what I mean, right? And here it just tapped the opening of the gap, the start of this gap. In the 50%, it's obvious that it's the 50%. I'm not even going to double check that or give you a justification. So levels to look out for: the open, the 50%, and the close. These are the levels that you expect to be reacted from. And for the highest quality fair value gaps, you don't even expect the 50% to be closed below, right? You don't expect a close below the 50%. Now, one of the things that is important, the only thing that matters, just like in market shifts, which we will talk about, or we've already talked about, is the wicks. It's the candle body closures. This can happen, and this fair value gap would have not been disrespected. Actually, quite the opposite. It would have held. Therefore, I would still think that this is a bullish fair value gap. The same thing on the bearish front, that if the market moves all the way up, let's say we have a very bullish candle, this is a disrespected fair value gap, but this isn't, right? No matter how large it is, the wick, as long as the market closes inside of the fair value gap, and even better if it's above or below the 50%, meaning it should not close below the 50%. So the market shouldn't really be closing. So we should have no candle closures below the 50% if you want the fair value gaps to continue to be high probability. Anything above, it's still fine. Now, next, let's talk about the quality of fair value gaps. We have low probability and high probability fair value gaps. Low probability fair value gaps, they are not going to be at high value areas, and the third candle is going to be bearish in this sense. Why? Or on a bearish fair value gap, the third candle would be bullish. Why is this? So why is the quality of a fair value gap marked by the third candle? It's because a fair value gap, for example, a bullish fair value gap, it's supposed to mark that there's a lot of buyers stepping into play. So much that there's a gap in fair value where orders were not really filled in the middle. And if the third candle is showing you bearishness, that means that right at the end of the pattern that we are looking for, we are trying to recognize, to identify that buyers are stepping into place, sellers step into place. Right? So you can put two and two together and understand why a low probability fair value gap is usually a fair value gap that the third candle is against the direction where we want the fair value gap to go into. And they're not at high value areas. And then high probability fair value gaps, they are always going to be marked by being at a high value area. In this case, for example, we have the previous low on a bullish fair value gap or a previous high in a bearish fair value gap, and the high value area is crucial because I'm going to give you a disclaimer instantly, which is all of these concepts have to be applied in the right area of the charts, which is high value areas, because it does not matter like if you're watching the 1 minute, you're going to see so many fair value gaps, and so many of them are going to be absolutely decimated by price, because the lower the time frame you go, the lower the quality of the fair value gap, because there are so many more, right? So I could give a lot of a lot of comparisons here, but I don't like where my head is going. So let's just say that the higher the time frame, the higher the probability of a fair value gap, especially if they are in a higher time frame key level. For example, on a daily chart, all of the fair value gaps are going to tell you something very, very important. All of the order blocks are going to tell you something very, very important. But if we go on to the 1 minute, then you need to look for all of them in a high value area. So if we are not trading at a high value area, you refrain from trading. You do not trade this on the lower time frame. Right? Because if you are trading the 5 minute and you are stuck in a range, but you're so stuck in the 5 minute that you're only seeing this pricing and that there's a bearish fair value gap, and you don't think about the rest of the market, of the daily, of the 15 minute, of the session, etc. We'll talk about all that. Then you're going to be absolutely decimated by the market. So a high probability fair value gap is going to be at a high value area or at a high time frame, and it's going to be marked by 3 very nice candles, and the third one should not be extremely impulsive unless you want a breakaway gap, right? So now let's look at the DXY. because I want to explain what I mean with on the daily, the fair value gaps, all of them tell you a story. So for example, let's go on to the weekly actually. So on the weekly, we started seeing, look, bearish fair value gap that was marked by this third candle that was very bullish. This fair value gap gets completely broken through and then the market just trades higher, right? Then we have, for example, when the market is bearish, what can you see? You can see bearish fair value gaps all the time holding, right? Then let's go on to the daily. It's going to give you more information. For example, right here, the market sweeps the low, moves higher, then creates the fair value gap, comes back to the fair value gap, moves higher, right? Then in this case, it was the order block. Then once again, we have a fair value gap, you have a reaction. This fair value gap gets broken through and then the market moves bearish, right? So the fair value gap, they tell you a lot of stories. For example, this is the analysis right now. And you can see that we're seeing fair value gap, bullish fair value gap that was inverted, bearish fair value gap, boom, there you go. We had a very nice reaction out of it. Bearish fair value gap moves lower, right? So you can see how the market just holds up consistently, right? The fair value gaps, they hold up consistently. We have move higher, move lower, market shift, which is going to be our entry model. We have fair value gap, moves higher. Fair value gap, moves higher. What else? I need the pencil again. Fair value gap, you get the reaction, moves lower, but then moves higher. Fair value gap, moves higher, right? You can see how fair value gaps are very good at telling you the direction of the market. If you're seeing an overwhelming amount of bearish fair value gaps, especially if they're not being tapped into, then you know that the market is heavily bearish, right? If you see no fair value gaps, most likely it's a low probability time to trade, right? So with that being said, we'll go into the more application side of it, of the fair value gaps, of how you can pick the direction, how you can use them for direction, mainly for direction when we're talking about market structure. Market structure, we will talk about the first signs of a reversal, and we'll talk about fair value gaps there a lot. So hope you enjoyed. This is a brief overview of fair value gaps and how they are important for the market. So I will see you in part 2 and I'll see you tomorrow. Hope you enjoyed this lesson. Click right here to watch the next one. And if you are struggling with overtrading, then click right here to check out Trade Blocker. Peace.